Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We do this show to try to help you have a better retirement. Whether you're already in retirement or looking forward to it, I think we have things that can help, both groups here. And we do that by answering questions. And so you can send in your questions now if you want. You can do it two ways. You can send in email at asktom, talkmoneywithtom.com, or put it in the chat on the channel itself, and we'll try to answer those questions live. You can send in the emails, during the week, and we often include questions that came up in our client strategy sessions also. So hopefully that helps you. You can grab onto something and use that. Another great idea is to just go look at our channel. We have over 1,500 videos here on the channel now. You can subscribe to the channel. You can hit the bell button to get notified, when we put out new content. We believe that education in the area of retirement, in retirement planning, asset management for during retirement, and what to do in terms of tax planning are important components, and that's what this channel has, a lot of videos on. So hopefully that could help. And then, of course, lastly, if you just want to meet with us to ask us specific questions, we do have our schedule is online. You can go to our website. There's a button looks just like that up in the corner of our website. And just set up a 30-minute time in office, on the phone, Zoom video, whatever works best for you, and we can meet with you in that regard. So looking forward to today's show. Already have some good questions come in, so feel free to send in some new questions. Be happy to answer those as far as that goes. So now at the beginning of every show, I like to do a little summary for what I saw happening in the stock market. So, Monday through Thursday, I do a short video on what happened that particular day. And today, I just kind of want to capstone all that together for those people that just really want to watch it once a week. So let's start off with our chart that we look at pretty frequently here. I'm just going back to 2018. And you can kind of see, what's been going on. Overall, market's pretty good, but lots of drops in there. We had a 20% drop in 2018, a 35% drop in 2020 with the pandemic, 28% drop in 2022 with the higher inflation. But here we are, still going. We've had a couple of, off weeks, definitely.
Yeah, this week's been pretty volatile, even
Yeah.
though the chart looks very smooth, and it's kind of similar place to where we started the week.
Yeah, I know. It's luckily today is a good day. Otherwise, that wouldn't be true. But it is kind of fascinating that the data that's out there going back to 1928. The first half of July is the best half, and the reason is because there's all these big funds that are rebalancing and placing money into the market on a quarterly basis and a semi-annual basis. So you get both at the very beginning of July. But the data also shows that the market starts to soften on the 17th, which is exactly the day that this thing started to soften. Our peak all-time high is on the 16th of July. So there is a seasonality here, and it makes some sense. This massive amount of money comes in, and all of a sudden it's in, and you're going to get kind of this, falling point because there's not enough money to kind of keep it up there, and it's the summer. Generally speaking, between now and end of October, there are a couple of periods in there that aren't too bad, but it's not the strong part of the year. November is actually the biggest month of the year, altogether. And of course, during an election, in my experience with all the elections, November has been very good. Once the election is over, market kind of takes off no matter who wins. And so, we have these things going on. Now, of course, I'll put my little line in here. If we're looking at primary direction, just looking at the lows, and we don't want to set a new lower low. In this case, that line is at 49.67, right? We are almost exactly 500 points above that right now, which is, roughly 10%. We could get down to that line during this weakness, as we go through the rest of August. September is the worst month of the year. I think it's the only one back to 1928 that has a negative average rate of return on the S&P 500. So that's coming at us. We've got, just be prepared. The pieces that are really going to be driving this market, in my opinion, are, the seasonality, the fact that there's an election in November, so some people might be holding back and just waiting to see what's going to happen before they, move in once they kind of know where things are. On the other hand, you have the Federal Reserve, right, that is sitting there looking like they might be cutting rates in September. So that's the worst month of the year. Could be offset by a rate cut.
Yeah, they're meeting next week, I believe, on the 31st
Yeah,
is
that's
their
right.
next meeting. And then right now on the watch tool, it's saying that it's more than it's 100% for
Yeah,
the cut
100%.
in
Wow.
September now.
Yeah, so that's the expectation for next week is no cut. It's almost 100% no cut, actually. But there may be a setup. That's what they're expecting. So, some conversations about the rate cut that would happen in September, and we're hearing better and better things from the Federal Reserve in their interviews across the board, specifically because these inflation numbers are coming out better. I'll show you a couple of those as we go here as far as that goes. So, all right, so here's the kind of primary trends, breadth indicators, those types of things. No change from last time. We're still in a, primary downtrend, at least on an hourly basis, really from the, 16th of July. We're still, we're vacillating, but overall been moving down, on that basis. But daily, weekly, and monthly, we're still in a primary uptrend. And then amongst the different pieces here, the Vanguard Total Stock Market Index, the S&P 500, the Dow Jones, we're still all green there. Some of them are getting closer to turning into a different, primary direction.
I think SOX is
yeah, SOX is, that's got a little ways to go, because it just had such a big run up from that last low. It can fall quite a while before it gets there. And so sometimes that's what happens, right? It just gets too far ahead of itself. And it's got to come back down. It's not a straight line. But if it starts to come back down to a lower low and then keeps going, okay, then the direction has changed and there's a whole sentiment change. I don't see the market going in a primary direction down personally, because there's so many pieces that are driving this on a momentum basis, the artificial intelligence. Next week we get Meta, Amazon, Apple, Microsoft, all reporting. That's often been a catalyst week, not always like a huge upturn, but might stop a downturn, at least for a while. So, we'll see how that goes. This week, of course, I think one of the biggest catalysts was the Tesla and Google earnings on Tuesday evening. The market was down over 2% on Wednesday. First time we've had a 2% down day in like 356 trading days. So there's like 252 trading days in a year. So it's roughly a year and a half. We haven't had a 2% down. Yeah, it's actually the longest we've had number of trading days in a row since before the 2008 downturn. And so, it was kind of a big deal. Tesla missed earnings by 40%, quarter over quarter from last year. The quarter before that, they missed by 55%. And so their stock got hit at 12% drop that day. Google came out, I thought, with decent earnings. And I thought that was actually pretty good, but they did talk about higher expenses. They're going to be investing more in their artificial intelligence, unit essentially. And some of their guidance was a little bit weaker than, they might have wanted. And so Google is down 5%. And so if the tech stocks are driving everything and they're starting to have, these reports that aren't received as well, and they're kind of priced for perfection. So, they do need to keep doing well in order to stay up. And so what we're seeing is some rotation. So let's talk about that, because I think this is very fascinating. So this is the S&P 500, which is the green line, versus the small cap index. In this case, we're going to use the iShares, Russell 2000 ETF, ticker symbols IWM. This is the last 5 years. So green is the S&P 500. It's up 83%. And the orange is the small cap, ETF, which is up 52%. Okay, so obviously the larger cap components of the S&P 500 were the place to be, right? But in the last month, we've seen a pretty big shift. And let's talk about this just for a minute. So the S&P 500 is basically zero in the last month, right? If you look at that green line. And the Russell 2000, ETF here is up 12%.
Yeah,
okay?
That's a big difference, especially with a month.
It's a huge difference. Now, one thing I will caution everybody about here, I don't know that we have a full trend here, because the initial portion of this motion comes off of record short interest on the Russell 2000 index. And so on Thursday, a couple weeks ago, we had a really good CPI report that came out, and boom, the market started to move for the Russell 2000. And matter of fact, that particular day, the NASDAQ was down 2%, Russell 2000 was up 3.5%, right? So that's a really big difference. because what's happening is if you're shorting, you want it to go down. If inflation's going down and it looks like there's a 100% chance of a rate cut, that's a good thing for small caps.
Yeah, small caps tend to borrow a lot of money to
Yep.
grow, and so having cheaper interest is always good for them.
Yeah, they're more economically sensitive just because of the size, right? They don't have 200 billion in cash or some crazy number like some of these big companies do. And oftentimes, one of the reasons you'll see these big companies doing well is because they're really kind of a safe haven. If you're not sure about what's going to happen, or if inflation's coming back, or they're going to cut rates, then maybe you buy the Microsofts and Apples of the world, and Nvidias, because they generate cash. Versus, hey, if things look more certain, you might move down the spectrum of market capitalization, and that's when you start to see small caps go. Now, that's a great thing to see breadth and motion. However, if you look after that first surge, we've gone sideways for a while here. We need to break out of that to see that next motion, because unfortunately in the small cap arena, we've seen a lot of false moves. And where it just hasn't gone anywhere. Matter of fact, if you look back at the 5-year chart, you can look at that orange line. It really hasn't gone anywhere since 2021, right? It's still kind of at the same spot. It's looking like it wants to break out. But let's see. But I think it's an important component to watch. Another thing that kind of shows the broadening breadth in the market is the S&P 500 is weighted by market capitalization.
Mm-hmm.
So like the top 7 stocks make up some 25 to 40%. I've forgotten the number.
I think it's around 40 right now.
Yeah, of the motion of the S&P 500. So 500 stocks, and 7 of them are making the motions. So the equal weight S&P 500, and this is a Invesco ETF, ticker symbol is RSP. Instead of weighting the portfolio, or in this case the index, based on the size of the company, they just give every company equal amount. What is that, 2.5% or something like that? 0.2%, sorry, for each one. And so you can tell they're not too far off, generally over the last 5 years. Still the S&P 500 is up 83% in that time frame, and the equal weight is up 69%.
Yeah, you can kind of see in this last run up, it's where they kind of diverged a little bit.
Yeah, that low point, that strike that's right above my head there, that was October 27th. And small caps, I mean, in this case, we'd probably be looking at more of the smaller large caps and the mid caps that are part of the S&P 500. Didn't do quite as well, and actually since April, that motion, that second dip up there, the last bigger dip, we've really separated. However, if we look at the last month, again, differential S&P 500 at 0 basically, and the equal weight is at 3.7%. So what this is showing is that there's some motion going out into the market. This is a really good sign. Now, I think, and we're guilty of this too, in order to overperform the market with our targets, we've been in those larger cap stocks because that's where the money has been going.
Mm-hmm.
And this week we've been motioning out of those some. We got out of the semiconductor index and started to buy more small caps into targets. In our core positions, we're starting to use more of the total stock market stuff instead of the S&P 500. Again, giving us more exposure across the board to different types of stocks, different size stocks. And that's what you want to be doing right now. You want to be working on the breadth, in my opinion, in case this is something real. And I think it might be, because I think, again, the kickoff for this was predominantly a low CPI report. And so the market is starting to feel more comfortable with the fact that, inflation might be going back down to 2% and the Fed might be actually lowering rates. And that takes away some of the economic uncertainty.
It's kind of starting to be a risk-on event.
Yes. Exactly right. People are willing to buy smaller companies that have theoretically more risk. They don't have the same balance sheet as an Apple or Microsoft and such too. So I think it's very, very good, because this is what would happen in a normal bull market at about this point. Normal bull markets are 3 to 5 years long. We're 1 year and 3/4 into this. You should start to see breadth motion and start to see, the things spread out. Now, again, if your portfolio is super narrow and you're still in those kind of mainly 7 stocks, it's probably time to start looking at, breaking that out a bit. And that's what we've been doing and we'll continue to do. Our universe that we work with these ETFs kind of automatically, we see stuff move up by itself and the other things move down. It's a giant competition to get in the portfolio. And so it's sort of an automated process for us. But I'm telling you, that's what's happening we're starting to see, this small cap and these other types of areas, because the Dow is at an all-time high. It continues to do well. It's more of a value-ish index, at least somewhat so. There's only 30 stocks, but so that isn't true with the Nasdaq, which is coming down off of its highs, or the Nasdaq 100 for that matter, which is the more concentrated version. So today's report was PCE. This has been an important report for a long time. We've been talking about this for a long time. So if you've been watching our show, you probably know that PCE stands for Personal Consumption Expenditure Price Index, and this is the favored measure that the Federal Reserve looks at. And there's top line, which includes everything, and then there's core, where they take out food and energy. And core PCE, which is what I have here for the last 3 years, is what the Fed is looking at when they're trying to get it down to 2%.
Yeah.
Right? It's not CPI. It's not the headline PCE for that matter. It's not the wholesale inflation. It's this. So this unfortunately comes out really late. Just came out today for, last month. Here we are at the end of July. We're now looking at June numbers. But so today it came out flat versus last month, right? It was 2.62. It was adjusted.
Yeah, it was
upward.
adjusted up.
Yeah,
so
slightly.
If you're looking at May's data, it originally was 2.57%.
Yeah, 2.57 was adjusted up 2.62. And today's data for last month, and this is year over year, looking at the same month for last year, 2.63%. So I would rather have seen that kind of continue down, maybe get into 2.4s or whatever, what have you. But Jay Powell made a comment that keeps running through my brain, which is, we are not going to wait until it's at 2% to reduce rates, because then it could be too late and we could end up in a scenario where we have a deflationary event. So, and that's why the market's betting on, on this September cut. I don't see any reason other than some really wild data point that comes through somehow, where the Fed doesn't do at least some rate cut in September.
Yeah, it's starting to price in 3/4 on the Fed watch.
Yeah, that's amazing, actually, because that, always assuming a 1/4 point cut. Now there's been a little talk about a half, and a little bit of talk about a 3/4. Things would have to slow down quite a bit to get there. I don't see that either, but then that's a small percentage possibility. This is more of a long-term chart. It's kind of interesting. So the green line is just annualized over 6 months. And if you look at that, that's still going up, because the last 6 months has been a little bit higher, right? And then the darker blue is just the year over year, which is basically replicates the chart that we just had. So you can see that has been just a kind of almost like a bell curve. Interesting, if you look back before 2020, they were kind of struggling actually to keep inflation up high enough.
Yeah.
And so that is one of the things that they're being careful with here. They don't want to get too crazy on this downward motion of lowering rates, because they really don't like that either.
Yeah, they want to kind of glide into that 2%.
Yeah,
they don't want to
right.
really nosedive into it.
And if you look at the light blue, the annualized rate, just looking at 3-month time periods, at the end of last year, we were actually annualizing below 2%. And that's when the market started to take off, too, because the Fed started to probably worry that they might end up with inflation being too low. And they started to talk more positively to get the market to kind of keep inflation from falling.
Yeah, and the market was pricing in 6 cuts at that point.
Yeah, that's right.
It was very positive.
Exactly. Yeah, and then that's when the market, we had almost a 9% November, right, on the upside. So, that, of course, the yellow means the yellow line's the 2% target. So anyway, this is an important component for the market. Here we are in the middle of this negative week with, all these things going on. And today we're up because of this PCE report. You can tell it has some importance for the market. It's still something to watch for. Hopefully we can stop talking about inflation someday, because we didn't used to talk about it, really, because it wasn't a component of really what was going on. The Fed funds rate didn't change that much, prior to 2020, really. Some, they were going up a little in 2018, back down in 2019. It makes a difference.
It was more worried about economic growth
Yes.
and actual, employment. We weren't talking about inflation.
Well, honestly, we haven't had that kind of inflation since the 70s and very early 80s. And so the most common conversation that somebody like us would have would be about a recession, because we've had a bunch of those since then, and some really big ones like 2008 and what have you too. So that was the conversation all the time was, are we heading for recession? Are we heading for recession? And that is what caused the Wall Street to completely miss out on the 2022, fact that we didn't have a recession because it was just so different. And of course, the pandemic changed the dynamic, and then the money that came out from the pandemic. So, hopefully by this time next year, we're just talking about whether we're going to have a recession or not, because that was a lot more fun, honestly. If there can be fun there, because inflation's really tough. It affects every single person. Recessions are more hit and miss as to whether it's affecting you or not. It depends on your job and type of industry that you're in and where that recession might be. But everybody's costs have gone up, and so that's a tough one. Okay, so that's our summary for the week. I really thank everybody for joining the summary. I look forward to doing it again next week, and we'll start with our first questions.
Why has the market been so volatile this week? Previous weeks, it hasn't been as jumpy from up and down, but what changed?
Well, I think, first of all, it's just the seasonality for starters, because, the end of June is the end of a quarter and the end of a half a year. And so you've got these big funds. Some of them only do their stuff every half year. Some of them do their big rebalancing and such every quarter. And so it kind of doubles, maybe not doubles, but it magnifies the impact of this massive cash flow and rebalancing happens. And so what has been happening since going back really far, 1928, the first 2 weeks of the year of July are the best 2 weeks of the year on average, right? And so massive amount of money, that matter of fact, they called it a wall of money, comes in and it stops. And the peak historically has been the 16th, and the softness starts on the 17th. And that's exactly what has happened so far here. And so, you get tons of money, it drives the market up maybe farther than it should be. We had in that time frame, we had 11 trading days, and 10 of them were up. So that's okay. It's kind of like a little draft downward because there's not as much money. But you throw some things in there that kind of exaggerated that volatility. The first big tech companies that were reporting after hours on Tuesday this week with Google or Alphabet or whatever you want to call it, and Tesla, right? And so Tesla's earnings report was pretty bad. They, were 40% down on their earnings last quarter versus that quarter, same quarter last year. And that, of course, follows the 55% drop that they had, in the previous quarter report. So, that stock dropped 12%. It's a big stock. It's on a lot of indexes. It's still an important component. And if it falls 12%, it's going to bring these indexes down with it that are weighted on size of company. And then Google, of course, which is an even bigger stock, had a decent report, but ended up with 5% down based on some forward guidance and some expectations that they're going to spend more on kind of development of artificial intelligence and such. So that definitely played a role, and the market starts getting into kind of a negative mode too.
And average earnings reports, even if they're like okay beats, start to go negative.
Yes, yeah, the market can be kind of emotional in a way, right? There are periods of time where you could have exactly the same earnings report with the same wording from the same people, and in one quarter the market's in a good mood and it focuses on the good things and the stock goes up. And the next quarter, same exact thing, the market's in a bad mood, it's coming down a little bit, just picks off those negative things and it drops 4 or 5%.
It could change week to week.
Yeah, oh, definitely. Yeah, like next week could be very positive because of these companies or not. So it kind of cracks me up. It's kind of not that important in the overall scheme of things because all of it tends to kind of wash out. But the question is about the volatility this week. The market was in a negative mood this week. Monday was up nicely, a 1% jump. We had, of course, President Biden, backing out, and Kamala Harris coming in as the presumptive nominee, I guess you'll call. And so there's probably some volatility around that also, although mostly it seems to me, if you watch the charts, kind of minute by minute, it had to do more with the earnings and what's happening with inflation and, in my opinion, seasonality.
It was interesting yesterday, especially how it got to a very healthy green day, and then it just caved.
It was up 1% yesterday because the gross domestic product for the second quarter annualized out at 2.8%, which was better than expected. And so, that pushes off farther and farther the recession worries, as far as that goes. I mean, one of the things that seems to be befuddling people is that, the inflation rate is coming down. The economy is doing quite well, actually. This soft landing concept that the Fed has been talking about for a long time here is actually happening. So it's kind of interesting. And so it just brings that in, and it allows the Fed to reduce rates, because inflation is still coming down. So I think altogether it's a good week. The last 2 weeks have been volatile, but again, pick out some of the positives. Inflation is still okay. The GDP is good. We have a broadening of the stock market with the mid caps and small caps and other things besides just the big seven doing well. I think this is the beginning of setting up a nice run at the end of the year, kind of that fourth quarter run. We just got to, bear with it and deal with what's happening. But anyway, I'd say those are the main reasons why we're seeing volatility this week. I don't see anything that really concerns me. We were talking about this happening before it happened, and I think these types of things are positive. You get too much of it, and all of a sudden becomes a negative, and so it is a little scary sometimes, because all big downturns start with the small one. Not all downturns turn into big ones, so that's important. And a lot of the small ones are very healthy. They let off steam. They bring the price back down to something that people want. Last year we had a 10% drop, brought prices down, and boom, market just took off.
Yeah, April was the same thing. We had 5% down, and then May was a great month.
That's right. We made it all back in May too, and so and we're way above that. So, in order to get back to a in order to get out of this downturn, we have to set a new all-time high. That would be my rule as far as that goes. And so, it could take a little while. I think we have some more softness coming in the market. But there could be some surprise earnings. Maybe the Fed does some really happy things in their meeting next week. I don't know. Yeah. But generally speaking, once you kind of get in this kind of motion in this time of the year, I'd be surprised to see us flying upward, maybe sideways. But I think it's still likely we'll see some more softness. But we'll see.
So with the IRS giving regulation for inherited RMD distributions, what changed, or with inherited Roth IRAs, what changed with the new rules?
Okay, so this has been a kind of a big area. They changed the rules a long time ago, a while ago, a couple of years back, where you have to take out your money out of these inherited IRAs in 10 years, unless you're part of this other select group, like a spouse or maybe a sibling that's,
basically you're eligible beneficiaries, if you're within 10 years of the person who passed away, or a spouse, a minor, or you have chronic or some sort of disability. And so those are kind of those special cases.
So in those cases, there is no 10-year mandatory withdrawal, right? For everybody else, and for most of the people that we see with our inherited, like
it
the
usually
kids,
goes from parents to children.
So parents to children is generally going to be a 10-year mandatory withdrawal. But the IRS did not have any rulings on how you would withdraw that. It just, the only thing they had was at the end of the 10th year, you had to have it all out, right? Whether it was a tax-free Roth or a taxable IRA or a 401k or whatever it was, they want their tax dollars. Or at the minimum, if you're growing tax-free in a Roth, they want you to stop doing that, right, at the end of 10 years. So they finally ruled, after a lot of time, boy, they went back and forth on this. It took a while. They finally ruled that if the person that you are getting a inheritance from was already taking required minimum distributions, then you have to continue that. But the one weird wrinkle that they put in there is that with a Roth IRA, you do not have to take a required minimum distribution. So if the person that you're inheriting it from had a Roth and a non-Roth retirement plan, and they were taking money out of the non-Roth one like they were supposed to, now you inherit one or both. Because that person was taking a minimum distribution out of the non-Roth retirement plans, you have to actually start doing a required minimum distribution on the Roth.
Yeah, so
for yourself.
Yeah, basically, if you inherited both the accounts, so if you had, even if they had the IRA, if they exhausted it before they passed away and they only had that Roth, then you would not be required
Right.
to. But if you inherit even just $1 to an inherited IRA,
Right.
and they were taking RMDs, you're stuck with RMDs for the next 10 years.
Yeah. Now, it's not going to be too onerous. It just means that you don't have as much money that can stay in there and grow tax-free.
Mm-hmm.
The way that the requirement of distribution tables works is based on your life expectancy. So you're likely quite a bit younger than the person you inherited from. And so your withdrawals could be quite small,
Yeah.
2% or something like that. And so, it does take away from some of the possibilities, and it's kind of a hassle.
Yeah, so now you take those RMDs, but you kind of just defer it until the 10th year, and you just
Right.
kind of distribute the rest.
Now, there is one other caveat to this. If the person you inherited from either only gives you a Roth, right, or wasn't old enough maybe to be taking required minimum distributions
Yeah.
from their account. So let's say, because 73 is the age you have to. So let's say you inherited from a 70-year-old, and then they weren't taking required minimum distribution because they were not required to. You don't have to either.
Yep.
You can wait until the end of the 10th year and take it all out as a lump sum, or do whatever you want. You can take it out, a tenth every year, whatever. We do highly caution that if you have a fairly large, non-Roth retirement plan, 401k, IRA, what have you, that you really think about. Let's say you got $1 million, it'd be great, right? You don't want that thing to turn into $2 million and come all out in the last 10th year, because you're going to get killed on taxes. You want to start to do some tax planning and try to do some distributions during that 10-year period, even if you're not required to. The Roth IRA, if you don't have to do a distribution, I would recommend not touching it for that 10 years if you can. If you have to, that's fine. Things happen. But if there's any possibility that you can leave that Roth growing tax-free, tax-free growth with stock market potential is really, really powerful. And having $1 million turn into $2 million at the end of 10 years, which is just a 7% return, right? It is all tax-free. Now you get that $2 million out. There's no big hit on taxes. You just made $1 million tax-free over that period. Now you got to put it in accounts that are going to generate taxes going forward, but at least you maximize that 10-year period.
Yeah, you maximize your tax-free growth.
Yeah, I would really be looking at that strongly. So anyway, that's a great question. It's a really interesting area. Things have changed. That ruling just came out last week, right?
Yeah, last Thursday. So it's quite new, and it applies to next year. So you have some time to start to think about it and what you want to do.
Yep, exactly. All right. So our next question.
Does Biden withdrawing change the market?
Does Biden withdrawing change the market? It does a little bit. It's kind of interesting to see, because after the debate, the polls started shifting, and then after the assassination attempt on top of that, the polls started shifting to Trump. And we saw a couple things happen. Number one, we saw the green energy arena start to come down.
Yeah.
Solar stocks, whatever you wanted to look at, they were coming down pretty hard. Some of them are really coming down, but overall they were coming down. The other thing we saw happening, is the bond market started to deteriorate also, because one of the things that what they're calling the Trump trade is just that, he keeps talking about tariffs. Now, tariffs are considered inflationary, right? Because it increases the cost of the goods. And we're already in an inflationary environment. And so if he actually does that, then, the bond market is worried that inflation picks back up. The Fed has to start raising rates again. And of course, the bond market falls when rates go up, right? So when Biden backed out and Harris came in, all of that reversed. We saw the clean energy ETFs all start to go,
Yep.
And then the polls are looking more, at least even, if not, it's hard. The polls are,
it's kind of like a coin flip.
Yeah. Yeah.
It was interesting because Kramer came out and he said that, Harris is better for mega cap stocks because she has connections to the mega caps with Google being from the Silicon Valley. And so that was kind of a play there. And then also international, any companies that have kind of international trade would be better because Harris wouldn't be as, aggressive with her tariffs.
Yeah, exactly. So, the thing about this is that, over the years during these presidential, elections, you say stuff during the election, it doesn't always happen. So I think it's kind of silly the market reacts too much to it one way or another. The reality sometimes isn't there. However, Uh, it kind of breaks down to like, do they need congressional approval to get it done, or can they just do it on an executive basis, right? So
Yeah.
the tariffs, and Kennedy, I think, started that in the first place. It was supposed to be originally congressional approval only on tariffs, and then he bypassed Congress, and so now the president is basically the one that can do a tariff. So there's some worry about that, but the bond market is also coming back up since Biden backed out too. So it's kind of there's a little bit of play there, a little bit of action going on. So it has changed some. I wouldn't say it's I don't think it's going to have a lot of legs. We don't know who the president's going to be at this point in time, and but you will generally see some follow through after the election in some of those same areas too. But I don't think that's the big stuff personally. But yeah, it's a good question. It's interesting to see what's happening.
Should I convert my individual non-retirement investment account into a transfer on death account?
Okay, so I have an account, let's say what I call a brokerage account. So it's not an IRA, a 401k, it's not a Roth, it's just in my name, or it's in my wife's name and my name, or, I don't know,
Yep.
joint tenants or whatever it is. And so that we call those taxable accounts. It just means that if you buy or sell, it ends up on your tax return. If it pays a dividend or interest, it ends up in your tax return. Versus these other type accounts, usually you have to do some kind of withdrawal,
Yep.
to get something to happen. So motion inside of these accounts create tax. So if you have a living trust, most lawyers will tell you should have that account in the living trust.
Yep.
Because what happens is then that account bypasses probate and goes to those beneficiaries. And it's actually a really big deal to have accounts that have beneficiaries, right? Because if you look at an IRA, it doesn't go through probate because it has named beneficiaries.
Yeah, it makes your estate a little bit more efficient.
Right.
It saves
Right.
you time. You don't have to go to court. You don't have to worry about all that stuff.
Right.
And so transfer on death is basically you name a beneficiary for it,
Yep.
and then you went upon your death, it would be transferred to that beneficiary, and so it avoids probate, just like a named IRA beneficiary in an IRA.
Yeah, exactly right. So that's if you don't have a trust, right? You can just what is it? A pretty simple form, really. We add to the
Yep.
stack of forms to open an account. You can set up a transfer on death. We call it TOD. You add that to that individual or joint account, or set it up originally when you set that up. Really, I think everybody should probably have that because if you don't have a trust, then use a transfer on death to push that asset when you pass away directly to beneficiaries without probate. Because we have a couple cases that we've dealt with over the last 3 to 5 years that have gone through probate. Wow, it took forever. I mean, 2, 3 years, not uncommon.
Yeah, once you start to push more than $200,000, that's when you start to get into probate.
Yep.
California probate. That's when you need to start thinking about these kind of TOD accounts.
Yeah, and please make sure that if you have an account that has a beneficiary, that you have a beneficiary on it. We've seen situations where 401k person passed away and there was no beneficiary listed, which is, not a good idea because that thing is going to be in probate for a really long time. And so anyway, the transfer on death is a great concept to add to your accounts if you do not have a trust. And they don't already have a named beneficiary. So annuities have a named beneficiary. All your 401ks and Roth IRAs and 403bs, 457 plans all have the capability of having a named beneficiary. You just got to make sure it's there. And so it's these other what we call taxable accounts that either you put in a trust or you set up a TOD for it, and they'll bypass the probate court that way. So anyway, that's a great question. All right, I think we have time for one more.
Should I consider bottom fishing on companies after poor earnings / guidance or like a bad event? So like Tesla this week or CloudStrike over the weekend.
Yeah.
Are these are these opportunities to kind of dip by?
There are opportunities, certainly. I mean, you look back, I remember, thinking about some of the ones that happened not too long ago, like Netflix was really falling apart and having some bad earnings reports. And, they bottomed out in 22 or so. And man, it's up so much, 400% since that bottom. We saw Meta. I remember Meta had a 40% down day after a bad earnings report. I remember when he was talking about the metaverse a lot. And boy, the market did not like that at all, right? And so obviously that's had a huge run from that standpoint too. So there's some validity to it. Here's how I would look at it. First of all, um, I would probably only be one of the really big companies that I feel. I mean, even look back in the history of Apple, right? They really struggled. They got to a point where they had to borrow money from Microsoft to basically pay the bills. But they were still a big company with a big brand, and they were able to turn that around. So if you kind of were buying on that downturn and that bad news, you made some good money. GE though is a cautionary tale because this is a big company, one of the original Dow components from the 1880s, right? Super high quality company. That's had bad earnings, but they just continued, right? So that's the problem. Does Tesla continue like a GE, and now you're kind of buying a falling, trying to catch a falling knife?
Yeah, or you're gonna cut yourself, or you're gonna catch the handle.
That's right. Or is it like these other ones where there's a big turnaround? So I don't really do these type of dip buying personally, just because, you know, I like momentum. I like to see the results happening and jump on that wave. And I think there's more potential for hitting more singles and doubles in momentum investing than there is, in this dip buying. You get more home runs,
Yeah.
but you can strike out a lot more often too. So that yes, but would you buy Tesla now based on what's going on?
For me, I don't personally like single stock dip
Yeah,
buying.
yeah,
I like when it's kind of an industry or kind
hmm,
of a sector.
yeah,
So you could think about the pandemic with cruise ships or airplane travel, right?
right, yeah,
So yeah, they lost a lot of their business, but they were kind of bailed out. And then also, people are going to travel again using airlines, so
hmm,
eventually they have to come back.
right,
There wasn't any kind of thing that was going to stop them in the long term. Or you could
right,
talk about regional banks last year during the Silicon Valley bankruptcy, how a few regional banks failed, but as a sector, a lot of the banks are still sturdy, and so you could get that at a discount. So you could kind of think about industries. I prefer that because maybe you're not going to hit that home run, but you could get like a double or a triple, maybe a little bit
hmm,
more return
yeah,
than like just doing the singles.
yeah. So basically, what Easton's saying is that, using an exchange traded fund, you go out and buy all the regional banks, or most of them. Or you go out and buy, the cruise ships, all of them in one. What's the airline one? Jets,
Jets, yeah, yeah,
Jets. You can buy the airlines through an ETF. That what the reason we do this, okay? If you're right on an individual stock, you'd make the most money, and so that really appeals to a lot of people. But there's an awful lot of people out there that have underperforming portfolios because they've got really concentrated maybe into 10 or 20 stocks. And, enough of them are doing poorly to kind of really offset things. But the analysis to be right at that level is so much harder. You move up a level and say, okay, just look at the industry,
yeah,
right? So, hey, people are going to fly again. Let's buy that industry, and maybe it continues to do poorly for a while. But if I wait long enough, I'm gonna probably make some great money. Regional banks, they still are needed. They're not all going out of business. Matter of fact, they might get bailed out, which they were in a way,
yeah,
right? Sort of. And so, again, and that's going to come back as a group, right? You can go up one more level and actually look at, hey, it's the U.S. versus the other large countries versus emerging markets, right? And so which one do you, oh, the US, that's where the momentum is. And so you kind of, okay. And then, so I'm saying, so you can go up higher and higher, and it's easier and easier to be correct.
yeah. But you lose that kind of high end potential,
Yes,
but your bottom end,
right,
your risk is much lower.
right. Yeah, I look at it, trying to beat the market. I don't want to beat the market, by 10% because that probably means I'm going to lose by 10% enough times to make that a real problem. And so you really want, if I can beat the market by a couple percent, I can hit a lot of singles and doubles. That's just, it's just this is just from experience. I've been doing this my whole life, and I used to go after the home runs, and I've done all that stuff, and I've hit a few, but I've had enough strikeouts. And we're managing other people's money, so I'd rather be more conservative, working higher up in that realm, and so our targets we're looking at the more concentrated areas like a regional bank or what have you, right? And then our core pieces are these large pieces where we'll either be international or US or both, or large cap or all the caps. We have
Hmm.
some variance we do in our core, but pretty well diversified in the core altogether, just because you never know where the money's going to go. So
Yeah, if you're gonna do any kind of dip buying, always keep your position small. Understand that you're risking a lot when you're buying individual stocks, and so you should be cognizant of your risk.
Yeah, if you're right on a dip buy, it doesn't take a lot of money to become a lot of money. So you don't need to put massive money in those things just in case you catch the knife blade instead of the handle.
Yeah.
And so, that's a good point too. So, all right, well, that's a great question. It's kind of fun to talk about that. There's some of that going on right now, so we'll see how that plays out. But we will be here again next week. Send in the questions now if you want, so we can work on them during the week. You can send them to the email address, asktom@talkmoney.com. Of course, you can go start to learn more just by watching some of the past videos on our channel. There's a subscribe button there and a little bell button if you want to get notified when we put new content on there. And of course, you can just meet with us too if you want. Easton and I are available. Set up a 30-minute time to see us and see in the office, video, phone, whatever works best for you. So anyway, look forward to next week, and we'll see you then. Thank you very much.